Mortgage rates are falling while interest rates keep rising. Just yesterday, I released a video going over how we are seeing the biggest weekly drop in mortgage rates in 41 years, while the Federal Reserve Bank is working to still raise interest rates aggressively. And I asked you if you'd like me to explain why mortgage rates are falling while interest rates are rising, and many of you said yes, so I'm making this video. Now, there's a couple things that impact mortgage rates. One is the interest rate set by the Federal Reserve Bank, and the second is bond prices and bond rates. And the Federal Reserve Bank is working to raise interest rates. That makes mortgages more expensive, and we know that the Fed is working to continue to raise interest rates. But the second thing, which is the less talked about aspect, is bond rates. Now, you have a lot of different types of bonds. Bonds are loans, and you can have treasury bonds, which are loans to the government. You can have mortgage-backed securities, which are loans to help finance and fund mortgages. You have corporate bonds, which are loans you can make to corporations. And the least risky bond, this is what every economic textbook, what every financial advisor, what every economics person will tell you, is that the least risky bond is a treasury bond. It has been known historically as the safest investment ever because a treasury bond is a loan you are making to the United States government, and the only way for you to lose money on this bond is if the government defaults. And that's not likely because, well, we have the world's reserve currency. The dollar is the world's reserve currency. We have the strongest military presence. We have the strongest government, the strongest economy. And because of these reasons, a treasury bond is considered a safe investment. So treasury bonds, when you loan money to the government, they pay you a yield, meaning an interest rate. And mortgage-backed securities, which is another type of bond, are going to pay you an interest rate. So if you loan money to mortgage-backed securities, if you buy a mortgage-backed security bond, well, you need an interest rate. And the interest rate that you're going to get from mortgage-backed securities should be higher than the interest rate that you get from a bond to the government, because it's more risky for you to loan money into the mortgage market than it is to loan money to the government because, well, somebody's more likely to default on their mortgage than the government is likely to default on their national debt. Well, now if we dig a little bit deeper into that topic, what influences the interest rate or yield on our treasury bonds loans to the government? And that goes to a number of different factors, but one of them is inflation and people's worries about inflation, because inflation is the value of the dollar dropping. Inflation is when you have more currency out there, which devalues the value of each individual dollar. And when you have high inflation, people are worried about the dollar, so they sell off bonds. They don't want to own treasury bonds. And so that's when you see the yield, the interest rate on treasury bonds rise, because then the government says, we need to incentivize people to buy our treasury bonds. And how do you incentivize people to make an investment? Well, you got to give them a higher return. That's why riskier investments tend to have higher returns, because higher risk, higher reward. And when you have high inflation, it seems like a riskier investment, so the government has to incentivize you with higher interest rates. And that was one of the reasons why mortgage rates also went up, because now when treasury bond yields are going up so much, people would rather put their money in a treasury bond than a mortgage-backed security if mortgage-backed securities are giving you lower returns. Because what's a safer investment, a treasury bond or a mortgage-backed security? Well, a treasury bond is backed by the United States government. Mortgage-backed securities are backed by people's mortgages. And so if mortgage-backed securities are riskier, you would expect a higher return, which then pushes up mortgage rates. And what we've been seeing happen more recently, this is just in the last week or so, maybe just over a week in the mortgage market, is we have been seeing inflation levels or inflation worries fall. We saw the last CPI report come in better than expected, and the PPI, the wholesale inflation report, come in better than expected. So when the inflation numbers came in as cooler than expected, investors got really excited and they started flocking to treasury bonds. And that made more people feel safer buying treasury bonds, because people said, oh, the inflation worry is over. Don't got to worry about inflation. Let's buy these bonds again. So that then put downward pressure on treasury bonds, because now there was more and more buyers for treasury bonds. So the yield that the government had to pay wasn't as high. As the treasury bond yield fell, that allowed the yield on mortgage-backed securities to also fall. Remember, mortgage-backed securities are riskier than treasury bonds. So if the risk level on treasury bonds is falling, that allows room for the risk level on mortgage-backed securities to also fall. So the interest rates that mortgage-backed securities paid out, the yield also began to fall, which then allowed lenders to lend money out for mortgages at an even lower price. Now the question is, how long will mortgage rates continue to fall? I mean, they're still very high. Like a 30-year fixed rate mortgage, when I just saw maybe 15 minutes ago, was around 6.6%, which is better than where it was a couple weeks ago when it was over 7%, but it's still more than 2 times higher than where we were in the beginning part of 2022. So this is where now you got to go back to the two factors, the Federal Reserve Bank and bond rates. Now we know that the Federal Reserve Bank is working to raise interest rates. They made it clear. They said that they're going to raise interest rates in December again. That will have an upward impact on yields, treasury bonds, and mortgage-backed securities and mortgage rates. And they also said that they're going to continue to raise interest rates in 2023. How much and how aggressively will they do it? Well, that's going to depend on inflation. And inflation is also going to impact our treasury bond yields, because if people are worried about inflation, if December comes in and we have a worse than expected inflation report, then what's going to happen? Well, probably you're going to see people say, oh no, our dollar's in trouble. We're worried about the dollar again. And that's going to make less people interested in buying treasury bonds, which then pushes the yield on treasury bonds higher. If the yields on treasury bonds go higher, the yields on mortgage-backed securities go up, which then impacts the interest rates that you have to pay on mortgages. So you can start to see how the whole economy starts to tie together. So you're going to have to pay attention to what the inflation report comes in December and January and February, because all these things are going to impact people's perception of the economy and inflation and the dollar, and that will then impact where they invest their money. And so there's a lot of different factors coming together. Now, we do keep you up to date on what's going on with interest rates and inflation and the Fed here. But if you want real-time updates on what's going on in the whole economy, from stocks to real estate to crypto to everything in between and the global economy, you can join Market Briefs. It's a completely free resource that I created to help you stay updated and to help you stay educated and aware of what's happening in the markets. I'll put that link for you down in the description below. But this is where you want to be aware and understand that while mortgage rates have fallen temporarily, you're going to have more upward pressure in December when the Fed raises interest rates. And what happens with treasury bonds or mortgage-backed securities is going to depend on the inflation report that we get in December. So just understand that, because if you're looking to get a mortgage, don't expect mortgage rates to fall back down to 3% anytime soon.